Hi, everyone. I'm Rick Bensignor. Today is Tuesday, May 31st, and welcome to this week's In the Know Trader Show. On tap this week in trader education, we're going to say not everything deserves an official label, and that the press hasn't figured that out yet. So we'll talk about that in our sector overview. Let's do a deep dive into the technology sector this week. So we'll look at XLK, which is the ETF that is the SPDR sector macro ETF for information technology. We'll look at it also how it is relative to the S&P. And then we'll take a look at a bunch of the large cap, the biggest cap names in the sector. So we'll get to as many of those as possible that you see in front of you. Our 7-Eleven report typically comes out Thursday nights from In the Know Trader. Also, we have a monthly 7-Eleven report. The new one comes out tonight because it is the last day of the month. The goal of that report is to beat the S&P by being in no more than 7 of the 11 of the SPDR macro sector ETFs. There is no other choices to be in but those 11, and picking the 7 that we think will outperform or do their best versus the S&P. Through May 15th, the last time we updated this, we are outperforming the S&P by 2.79% this year. In our fiscal year that started August 1st last summer by 3.8%, and total history going back, that should say 21 months, from August 1st of 2020, outperforming the S&P by 6.4%. These are huge outperformance numbers, puts us in the top 10% of all active money managers out there. And so if you've got money in SPDRs, I would tell you, consider looking into getting this report, because you will do better than SPDRs over time based on past performance. And of course, no guarantees here, but we are pretty consistent month after month of beating the S&P. And when we don't beat, we rarely lose more than maybe 20 bips versus the S&P, but we're frequently outperforming by 30, 40, 50, 60, 70. And so, and I think this month too, we're going to be kind of a decent amount. I know for the first half of the month, we were outperforming by 108 basis points in the first 15 days of the month. We're going to give some of that back, but I still think we had a good month. I'll know when the market closes today and I run the numbers. But this is something for any of you, if you are a financial advisor and you put lots of your clients' money into SPDRs, consider subscribing to this report. You will do better. And of course, individuals who are passively investing, this does better with minimal involvement on your side, minimal cost on your side, and more than recouping the very inexpensive fee that we charge for this monthly report. So consider the products that intheknowtrader.com has for you. Here is the month-to-date results of how the market's doing, not including today. So looking at this in relative terms to how the S&P is doing, energy still the big outperformer, up by 17% versus the S&P. Simply month to date, it's been phenomenal being in energy. Oil's up another couple bucks today. It was up $4. Now it's only up $2. But still, huge outperformance on the energy side. Second best performer, utilities, financials, healthcare, materials. Good. Then you've got communication services. The big losses this month, of course, are consumer discretionary. They've improved from where they were, but they're still trailing by about 6.4%. Real estate down 4.6% versus the S&P, and consumer staples is, the big one that it caught us this month because of, Walmart's earnings, that then Target's earnings followed through on that. Staples, getting hit hard versus the S&P this month. But nonetheless, you've still got more winners than losers here. And you can see the losers are really concentrated in real estate, staples, and consumer discretionary. So that is that. Let's talk about why I am going to spend time on a Tuesday with you saying that not everything deserves to have an official label. So this relates back to a show I did for you a couple weeks ago where we talked about the role of the press, the understanding that they are a business foremost, and that they're in business to either sell you newspapers, have you go to their website, watch their TV channel, whatever it is, they are doing this for profit. And as much as they may claim that they are, whether it's fair, unbiased, almost everything is pretty slanted these days. It's not so easy to find a pure news reporting that doesn't have some type of political agenda to it. But I'm specifically talking about this today because of what I think the press has done a huge misservice to the investing public this year by trying to be so cute to say that when the S&P was down 19.9%, that we were not in a bear market and that we were on the edge of a bear market. And that now that we bounced 6% last week, that we didn't have a bear market. I think trying to label everything that happens in the market as either you're in a bull market, you're in a correction phase, or you're in a bear market is just silly, especially the fact that we so toyed with this minus 20%, and they're telling you, well, we haven't entered bear market territory. All you had to do is be invested in the market, see how the market traded, look at how many days you had closes less than opens this year. And in every sense of the word, this market traded like a bear market. And for them to say that we didn't have a bear market and we just escaped having a bear market is trying to put a label on something that A, doesn't need the label, and B, it's not created by the press, but this idea that 10% is a correction, 20% off of a low is a new bull market, or 20% off of a high is a new bear market is just plain silly. It is trying to put a label. All you had to do is check out price action. Not everything has to have an official label to it. And if you were waiting for the press to tell you that we're in a bear market before you did any selling this year, they have just done a terrible misservice to you. So, as I said a few weeks ago, do your own homework. Pay far less attention to what the media tells you. The media is not in existence to do right by you. They are to do right by themselves because they are companies that are looking to make profit. They care about what their shareholders, their returns to shareholders and investors are, and they really don't care a heck of a lot about you, despite the fact that they will tell you that they do. This was another perfect example of how little they care by the fact that they tell you we didn't have a bear market because we only got to 19.9% down from the highs. Not every part of the market, not every move in the market has to have a label. Of course, daily, or whether it's a business news channel or a business newspaper, they need to come up with reasons why the market did what they did or what it did. Their writers often have no clue, but they've got to come up with something every day to tell you what's gone on in the market and why it happened. And I will accuse them now of saying that their role is to report the news, not to create the news, not to keep things in the public's mind that were never proven in the first place. So this whole idea of a 20% decline is a bear market, if that is what is generally accepted, which is what they'll say, it's only because they themselves made it so. You cannot find the person that declared that a 20% decline from a high is a bear market. There's nobody who this is attributed to. It is the press themselves who proliferate this idea that is unproven and is just a general rough categorization of a market move and what would potentially make people become more bearish or not. Sorry, we've been bears for quite some time. From early this year, we were telling you this was going to be a two-way market, not a buy the dip market, but one that you needed to sell also. Can you imagine if you just, were first going to wait for the official announcement that we were in a bear market before you actually did something? That for those people who don't pay a ton of attention to the market the way active traders do, the way mostly, if you're listening to this, chances are you're involved in the market. You're probably trading the market to some extent. You're not just a complete long-term holder. Don't be sucked into what you see on TV, hear on TV, see in the newspaper, or on a website from supposedly experts. I'm really disappointed this time around with the press and this whole idea that we didn't go into a bear market in the S&P. That's just major BS. And it's people and reporters trying to put a label on something that doesn't need a label each and every day. Look at how the market traded. We clearly traded in bearish format for the entire year. Thank you very much for telling us that we weren't in a bear market when we, as far as I'm concerned, we're completely in a bear market. So that's my thoughts on it. And think about this in terms of how much stuff you read that tries to have a label assigned to it when it doesn't need one. All right, let's get to some charts. First up, XLK. All right, here's Info Technology, outright chart. This is not versus the S&P. We'll take a look at that in a second. Standard weekly bar chart. We've got the bounce. Now let's see, I don't have a way of making, hold on, maybe I do. Let's get rid of trend here. Yeah, I can at least make my mouse into a bigger white colored pointer. So price is broken underneath the cloud. The lagging line broke a little bit above the top of the cloud. We got the bounce in here 3 weeks in a row, same type bottoming format before last week's big surge that brought the S&P, the QQQ, and the Dow Jones all up over 6% on the week. So, good trading low from support levels that have held. The horizontal lines are prior lows on the way up. So we came into that zone. The one thing that we don't have on a weekly chart are downside exhaustion timing signals from the DeMark work that we will look at. So near all-time highs, we had upside exhaustion signal. This hasn't come in yet. And I can look at a standard sequential, which is only on an 8 count, and aggressive sequentials on a 10, which is going to come more quickly. I can look at aggressive combo is only on a 10, and a standard combo is, where are we? We're on a 9 or a 10 also. So what we don't have yet is the defined bottom we do on a daily chart, but not on the weekly charts. Therefore, we're still kind of potentially in sell on rally mode. And where do you want to sell on rallies? And where, in this case of XLK, where does the game change to know that the likelihood that this bottom is a true bottom? You'd have to get above 154. This horizontal dashed green line is the propulsion momentum level on the upside. Anything beneath that, you're still kind of sell on rally mode up against different resistance levels. If you're very aggressive, you sell against the conversion line at 144-ish. If you want to wait for a move back to the hitting the bottom of the cloud and or against the baseline, that's 152 and change and or 154. So you probably want to be at least near 150 to 154 before you put on more significant sells. So for the time being, this is what we've got the picture of in the market. And can I play for a near-term bounce? Yes. Do I want to chase after where we closed last Friday? No. If I'm going to be a buyer, I'm going to be a buyer somewhere more on a pullback inside this. But just know that it's not going to take new lows for us to first get into a bear market. The whole year has been a bear market. Traded like it every sense of the word. If I flip this to a daily chart and we make this, give me a second, I'm going to make this candles. It doesn't take a lot to see that the bulk of trading days this year were black candles, not light blue upward ones. And the more times in a downward trending market, you're going to have closes less than the lows, or what you would call a closed candle. Here we show them as black. You're going to have a lot more closed candles than open candles. When the market's moving up, like it did here on the March bounce, you're going to have a lot more days where the open is above the close. I'm sorry, take that back. The close is above the open, and that's what you see when the market's moving up. Look, since essentially January 1st, the bulk of the days are down days, and it's in the neighborhood of probably 2 out of 3. So that's not a bull market. That is the characteristics of a bearish market over time. I don't care so much about a short-term move over 2 weeks, but generally now we're looking over months. And if we were to count the bars, you're going to see something like 2 out of 3 are down closed candles. And that's how you knew you're in a bearish market. I don't need the Wall Street Journal, Bloomberg News, CNBC, or somebody else to tell me if we're in a bullish market or a bearish market, what's a bull or a bear market. You can observe it yourself. And that's what I recommend. Pay far more attention yourself than to listening to all this other malarkey coming from the press. Here is a chart of XLK versus the spiders. All right. So this is historical from day one of their trading back in 1999 or 1998 when this all just started. This is relative performance on a monthly basis. The reason I'm showing you a monthly chart here is that tech got the 13 in 2020. COVID hit. We sold off. It then recouped, made new all-time highs, stopped right against the risk level from this 13. It's come right back down. And now we're at an important juncture again. We're at the monthly baseline. If we get, today's last day of the month, so it's not going to be an appreciable close either way. So we'll see in June whether or not this continues to break down. If it breaks down more, then there's 2 scenarios that come into play. And we'll look at a weekly chart in a second. But the 2 scenarios are you're starting a head and shoulders, of which you already have the left shoulder. We could come down. And if we stop anywhere near kind of here, you get a bounce. You have then the left shoulder and the head, and you'd expect one more rally in tech before a bigger move down. If we look at this on a weekly basis, and let's zoom in now. Actually, here, let's even go back. Notice the lagging line from the cloud chart. That's current price pushed back 26 bars. We can go back now to here. This is already 8 years. The lagging line has always been above its cloud. Look what we're dealing with right now. The last couple months, we're toying with coming through the bottom of the cloud. We've been able to hold on here, and the cloud actually, the bottom of the cloud goes a little higher over the next few months, and makes it much easier to pass through than when it's thick. So if we pull through, you up the odds that there's still more downside here, and that we end up finishing out, let's say, a weekly count in relative terms, which we still don't have a bottom for. If I add combo to this, let me see, where are we? Yeah, we're only on an 8 count in combo. So you just don't have enough sense that there's a definitive low other than the trading low that we put in. But I'm talking about a bigger, longer term view. We don't know yet if this lagging line is gonna hold in here. And if it comes through and we make new lows in relative terms, then we are most likely going to finish out this count. And we're just simply not done with tech on the downside. All right, so that's XLK and XLK versus the S&P. Let's take a look at some of the key components that make up the XLK. We'll walk through these in terms of the highest. Well, I had Amazon, but I'm going to take this away and make it Microsoft, because we'll go in cap order here from the largest cap names out there. And these are all large cap, but let's go to right now, Microsoft even has larger cap than Apple. So here's what we have. Lagging line still above its cloud. Price is broken beneath the cloud. That certainly puts you in a much more cautionary note. That doesn't happen very often at all. If we go back in time here, you can see it takes a heck of a lot to get price beneath the monthly, the weekly cloud. You had a couple of weeks here back in, what year was this? Let's see. That was in 2018. So it's not too often that we break beneath. And as we look now, we see we've spent a month beneath. You're going to have some resistance here in Microsoft starting, somewhere around 280, more at 295. And this is what we're dealing with now. Price did go to its TDST line at bottom there, but again, we don't have enough of a definitive bottom in place here to not think that there's still some element. If I were to draw a trend line off of the high, so that's the most relaxed trend line off of all-time highs, and here is the secondary one. So you can see where that comes in, and you can draw these yourself over the next, several weeks. Both lines are downward slope. They're going to have lower values each month. And as time goes on, let's say we went sideways for another few weeks and then rallied, well, then you're going to have the bottom of the cloud almost the same place as the downtrend line, as the same place that a propulsion level is. Now, all of a sudden, you have three unrelated reasons all being in about the same place. Better place to do some selling if you're looking to do that. On the downside here, let's just quickly flip this to a monthly chart. Notice the monthly baseline caught this month's low, just like it did in 2020. So right now, that low is a good low in the bigger picture. But if we come beneath there in the month of June, then we've got more problems. Okay, that's Microsoft. Let's take a look at Apple. And we'll start, I guess we can start with a monthly. So here's the monthly chart. Didn't sell off nearly as hard as Microsoft had, which had come all the way down to its baseline. Apple's, hanging in there relatively well, but on an outright basis, even the monthly charts have 13s and 9s on the top. So it is defensive. And excuse me, here we can get down to potentially this baseline at 121-ish and 123-ish is the TDST line. So that's the real support. Right now, look for potential resistance as we go into June, somewhere now around 157, 158, which is where the conversion line is that we've closed beneath. We haven't closed beneath the conversion line. Also, just a hair back here in 2020. So it's really been a while there. So that's, it shows you that there's probably, again, this is a two-way market and you want to play it that way. Here's Visa on a monthly chart. Notice how many lows came in against the baseline, but now we have a high against. In fact, the last few months, it's been struggling against its conversion line. So you're going to probably see some more price action in there. Tough to make a case that it's going to do a heck of a lot better than that. Here's a weekly chart, pretty much going sideways, mid-range. Nothing to do right in here. Mastercard, ticker MA, same type of thing. Sideways, nothing you're really going to discern much from this. Let's go to the monthly chart. Same thing, baseline low. Now this is above the conversion line as we go into month's end. It's been above there the last 3 months, gives it a little better view than some of these other charts, but tough to say whether or not this is still going to go and make new highs. Resistance at 408 to about 420. Nvidia. So here, monthly chart, this topped on a setup 9. This is much weaker. We are beneath the monthly baseline. Next support I show is down at 133 and change. So this may not be done yet. If we get a rally, I would look for resistance against this conversion line. So pay attention to that on a weekly chart. The good news is we have weekly 13 here on the bottom. You can see where resistance is going to be over the next, several weeks to months. Bottom of the cloud stays flat, and then you've got propulsion and the conversion line here. So that zone up here, 225 to 240-ish, going to be resistance. Broadcom, AVGO. We're getting a bounce here the last couple of weeks right on the top of the cloud. One of the better looking charts, still sideways, and there is some overhead resistance, but as long as we stay above this cloud, that looks good. A couple of weeks from now, the bottom of the cloud goes flat. That's right around 550. That's going to be important. And we'll do one last name. Let's do Adobe. One of the weaker charts, lagging line has broken its cloud. So structurally, this is a much worse name. You're going to want to be, if you own this name, you're going to want to use rallies to sell into. I'd expect to find some pretty decent resistance against the baseline as well as the cloud going forward. This one does not have an easy case at all to make why this would turn around and make new all-time highs anytime in the foreseeable future. That's it for this week, guys. Hope you enjoyed the show. I'm Rick Bensignor. Thanks for listening to In the Know Trader.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.